Good afternoon, and welcome to Getting Started with Thinkorswim, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend James Boyd, 20-plus year veteran of the financial markets, and a pretty good guy most of the time, even if he does use Milwaukee tools. We'll talk about that as we get into this discussion. And as we get started today, welcome to all of you. You're hearing the live version, you're watching this in the recorded version. Either way, we're glad to have you with us, and thanks for joining in the conversation. James is going to be there to help answer those questions along the way, and we're going to jump right into this discussion. My thought today was we would spend a little bit of time talking about 10 different ways that we can view and use volatility on the Thinkorswim platform. So we're going to show you 10 different ways to look at volatility on the Thinkorswim platform today. A couple of quick housekeeping items and reminders that we need to take care of, though. Remember that everything we talk about simply for illustrative and educational purposes only. Should not be considered any kind of a individualized recommendation or endorsement of any particular security chart pattern, strategy, or tool. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transactions. Remember that technical analysis, fundamental analysis, probability analysis, those are all theoretical ways to look at the market. None of those are guaranteed. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be looking today at the Thinkorswim desktop software platform, specifically the paper money version of that platform. Make sure that you're aware of the fact that that is not a guarantee of future success out there in the real world, but it's a great learning environment to practice and become adept at using the tools. Now, remember that investing involves risk, including loss of principal, past performance, no guarantee of future results, and probability analysis, which is a part of using volatility, is theoretical. It is not guaranteed and doesn't reflect any particular degree of certainty of a particular event occurring. And we'll point out some of those characteristics along the way. But just a quick agenda, we're going to navigate and explore the Thinkorswim platform. Like I said, I'm going to show you 10 different ways to see volatility on the Thinkorswim platform. We'll talk about what those tools are and what they mean. And we're going to use those tools and resources to help us to potentially evaluate example strategies and candidates and so forth. So let's do this. I'm going to switch my view over to the Thinkorswim desktop software platform here. As I do this, a great opportunity for me to remind you to click on that subscribe button down at the bottom of the page so that you can follow us on the Trader Talks webcast channel on YouTube. It also makes it easier for you to find this content. It also means that it's going to pop this content up to the top of the algorithm for you and for other traders. So if you haven't done so already, click on subscribe. It's at no cost to you to do that. Also, remember that you can follow me, you can follow James, you can follow all of the other coaches on X. We post some great stuff over there on our X handles. My X handle is at Ben Watson CS. James is at James Boyd CS, and you're going to see all of the other coaches there as well with similar naming conventions. Now, taking a look at the S&P 500 here, we're going to take a look and use the Thinkorswim platform 10 different ways to see what implied volatility or volatility as a whole is telling us. So I'm going to pop open my left-hand side here. I've got it on my scratch pad. 10 ways to see volatility on Thinkorswim. And the number one first way that we're going to look at volatility is we're going to look at the VIX, the volatility index. So I'm going to pop over here. I'm going to open up a chart and I'm going to take a look at the VIX. This is the volatility index of the S&P 500. And this is suggested by option pricing. This is looking at a 3-month rolling average of in the money, at the money, and out of the money calls and puts on the S&P 500. And it's a reflection of what the market's expectation is for movement. A couple of different ways that we can evaluate volatility. There's one thing to keep in mind with volatility. When it's low, it tends to go higher. When it's high, it tends to go lower. It is a mean reverting instrument. So when we get big volatility spikes like this one, or like this one back here, it tends to bleed off very quickly. Now, if you were to go back and you were to look at this on a longer term chart on the volatility index, if we were to change our time frame here to let's say a 20-year time frame here on the VIX, and you were to go back, the 20-year average of the VIX is somewhere down here around the 16 level, 15 to 16 on the VIX. And then we get some extraordinary spikes in the VIX. That's the COVID spike. That's the end carry trade. This is the tariff impact. So you get these big spikes, but overall the average tends to be relatively low. So using VIX on a chart, you can get a sense of a couple of different things. How pricey are options generally on S&P 500 stocks? Now, each individual stock is going to have its own volatility, but this will give you an idea of how pricey those options are kind of across the board, number one. Number two, it'll give you a sense of whether the market is reacting to movement. Typically, the VIX is driven by institutional investors. And so when institutional investors panic, they typically tend to react by buying protective options. So I'd never eat here, or I'm sorry, see, yeah, implied volatility is directly correlated to option premium. When implied volatility is high, option premiums generally are higher. It is inversely correlated oftentimes with the S&P 500. The purple line here is the S&P 500. The candlesticks are is the VIX. And you can see that correlation study that I've got down here. That correlation suggests that more often than not, this is almost a pure inverse correlation between the S&P 500 and the VIX. When the VIX goes down, when the market goes down, the VIX gets higher. When the market goes up, the VIX gets lower, and that's almost always the relationship. Yeah. So see, yeah, to a good point. When selling options, some option traders like to see higher implied volatility. Now, the VIX itself, VIX, that symbol, is not the only VIX view that's out there. So looking at VIX on a chart as an estimate of volatility, that's not the only way to look at it. This is the overall 30-day average of VIX. This is kind of the standard view of VIX, right? So we're going to come back in here and we're going to go to our lookup, and I'm just going to type in VIX. And as I do that, you're going to see that this populates looking at a number of different symbols that begin with VIX. So we've got a 1-year volatility index, which is a longer average. We've got a 1-day VIX, which is a shorter average of VIX. Some traders will use the comparison between the 30-day VIX, which is the symbol VIX, and the 3-month VIX, which is oftentimes a little bit different and tends to be a little bit higher. And so that tends to give a little bit of a comparison here. You'll look at that 3-month VIX. You've got a 9-day VIX. You've got a 6-month VIX. In fact, if we were to extend this out to more listings, you're going to see that you've got other products that trade with VIX in the name. So those are different ways that you can visualize volatility. All right. So think about this. And in terms of, George, to just simplify it, and I like digging into the theoreticals as much as everybody else. The way the VIX is calculated is simply taking a 30-day average of a cross section of in the money, at the money, out of the money, both calls and puts of the SPX index. So where those are, and on average, is what prints as the VIX. There are a lot of different ways to interpret it from a mathematical and statistical perspective, but that's just the simple way that is calculated. And you can look at the issuer of the VIX, Cboe Global, third-party provider of data and information, for more information about the VIX. So that's the first way to look at volatility in the market. Right now, just to kind of get a sense of what volatility is doing, volatility was quite a bit higher on that tariff impact. Now it's been bleeding off, and today we've seen the VIX move back up towards its, I put a 30-day or a 30 period moving average on here. So it moved up towards that average, and it has fallen from where it was earlier in the day. So VIX on the chart, one way to look at implied volatility or volatility on the thinkorswim platform. The second way that we're going to look at that is implied volatility or historical volatility, or both, on a chart of an individual equity. So that's the next way that we're going to look at volatility here on the thinkorswim platform. And by the way, there's also a feedback survey out there in the chat. So appreciate the opportunity to have you share with us some of your ideas about how we can make these sessions better. Let us know. Do me a favor, click on that feedback survey. You can open it up right now and set it aside. You can fill it out now, or you can wait. Either way, it doesn't matter. Just fill it out before we go and help us out to make these sessions better. So let's say we were looking at the chart of an individual stock. So I'm going to come down here and I'm going to grab my single grid. So we're just going to look at an individual stock. I'm going to bring up an individual stock that some of you might be familiar with, and that is Apple, AAPL. And you can see that Apple has largely been echoing kind of what the S&P 500 is doing. One of the things that we notice is that Apple has an earnings announcement. Guess when? Tomorrow. So the reason I'm bringing this one up is because I know something particularly happens to implied volatility or volatility as we get into an earnings announcement. So what I'm going to do, this is the number 2 way to look at volatility on the thinkorswim platform, is on an individual stock chart. I'm going to go up to the Flask icon up here at the top of the page. I'm going to come over to the left-hand side, and I'm going to type in the words IMP, or the letters IMP. And now I have implied volatility, okay? Implied volatility. And we're going to click on apply and okay. And now what I'm seeing down here at the bottom of the chart is volatility for Apple. And again, this is going to be an average of volatilities across options, across the option chain for Apple. So it's not representative of any one particular strike price or expiration. It is the average of implied volatilities across all of those options for the Apple option chain. Now, here's the thing about implied volatility. Implied volatility is taking what has happened and looking at expectations of what might happen. So this is representative, again, of options pricing. The way that implied volatility moves, the way that implied volatility really goes up or goes down, is simple supply and demand. If there's more demand for an option, the market maker is going to widen their bid-ask spread, or they're going to move their bid-ask spread, and that increases that volatility, meaning it increases that option price or it decreases that option price. It's no more statistical than that necessarily. It is simply as a function of implied volatility, and it is mean reverting. So when implied volatility is high, that's met by option selling. When implied volatility is low, that's met by option buying, and that raises or lowers those prices. Think about this. If you were a kid and you're standing on the side of the street and you're selling lemonade, you've got a lemonade stand, and it's a 100-degree day, you might start selling your lemonade for $1 a glass. But as demand grows, because it's a hot day, you're going to start to raise the price of that glass of lemonade. So now by midday, sun's out fully, it's 110 degrees. The price of that glass of lemonade is now $10 a glass. Well, if you're selling lemonade at $10 a glass, guess what? There's probably going to be other kids that are going to say, hey, cool, we can sell lemonade for $10 a glass too. Now there's 5 kids or 10 kids out there selling lemonade at $10 a glass. Guess what's going to happen to the price of that lemonade? It's going to start to come down as the available demand is met by more supply. So implied volatility is a function of supply and demand. Period. End of story. That's what it is. And implied volatility typically tends to go up when there is the potential for a news announcement or potential for movement. And you can see that happening here with Apple. Generally, implied volatility goes up as the stock comes into an earnings announcement. Once the news is known, that implied volatility falls off. Implied volatility goes up into the earnings announcement and falls off. Up into the earnings announcement and falls off. Up around an event and falls off. And here's kind of an interesting perspective. We had an earnings announcement kind of following this rise in implied volatility, which is maybe the reason why implied volatility is staying relatively elevated. Instead of rising, it's already risen to about that area where it typically rises around an earnings announcement. So probably not going to rise too much more going into the announcement tomorrow, but it could very easily start to come back down a little bit more. So this is the second way that we look at implied volatility, or volatility as a whole, on is to look at that chart on a stock chart. Now, there's one other aspect of volatility that I want to talk about here while we're on this particular chart, and that is the backwards look at volatility, or historical volatility. So historical volatility is what stock has already done in the past, translated into movement in the chart. So here's what we're going to do. We're going to come up here and go to our Flask icon one more time again, and we're going to type in the words HIST, the letters HIST, and we're going to choose historical volatility. So this is historical volatility. This is implied volatility. Historical volatility is going to be different color. So I'm going to click on apply, and I'm going to click on OK. So historical volatility is what the stock has already done. Okay. Historical volatility is oftentimes called statistical or realized volatility. It's what the stock's already done. It's not forward-looking. It is a statistical look back. And oftentimes, if not most of the time, historical volatility is a little bit less than implied volatility. The market tends to overprice expected moves. So don't spend a lot of time trying to correlate these two, or saying that because implied volatility is high, that those options are overpriced. They're generally always overpriced. So the Sarah Kumar asks a question, but why does volatility go down after earnings? Because the uncertainty is no longer there, right? Because an earnings announcement is a scheduled event that could move the stock price because it changes the information in the system. That creates uncertainty. That creates an expectation because that price could move. When that expectation is no longer there, when that move has already happened, or when the uncertainty is gone, implied volatility falls. There's less demand for options. Less demand for options to speculate, less demand for options to hedge against adverse movement. So implied volatility, historical volatility on the chart, that's the second way that we can look at volatility or see volatility on the Thinkorswim platform. The third way that we can see implied volatility on the Thinkorswim platform is on the option chain. And we're going to look at implied volatility on the option chain right now. We'll keep it here on Apple since we're right here on the chart. And we've already kind of seen the chart display of implied volatility. But what I'm going to do is I'm going to go to the trade tab, and we're going to take a look at the option chain for Apple. Now, here's what we're going to look at. Over on the right-hand side of this option chain, you're going to see two numbers. Let me grab my magic marker here, and we're going to line these two numbers out. You're going to see this column. It's this column right here, and in that column, you've got two numbers. You've got one number, that first number, which is implied volatility. So this number is implied volatility percentage, right? So that is going to correspond with that blue line, or that kind of greenish blue line that we saw on the chart for each one of those option expirations. So this number right here is the average implied volatility of all of the options that are, or all the strike prices in this particular expiration. Now, this number right here, this plus or minus 9.181, that number represents the expected move. I'm just going to write this EXP price up, up or down. Expected move up or down based on that current level of implied volatility. That's what the market is expecting, right? That's not statistically derived. That is not a forward, a backwards look. That is not some kind of weird mathematical calculation. That is simply taking this implied volatility amount and suggesting what the options market is looking at in terms of a move in this time frame, in this duration, up or down from where the price of the stock is right now. So 211 is where the stock is trading right now, okay? And plus or minus $9.08 from that level, that's going to put us up at about, 220, or down at about 201, 202, right? So that is that potential move, right? So again, it's going to be simply another way to see possible movement. I'll show you again as we get into some of these other areas how this relates. So that's the number 3 way to see implied volatility or volatility here on the Thinkorswim platform. We get implied volatility and the expected move, and we get that for each one of those expectations now, or each one of those expirations. Now we go out to an expiration. This is 900 days to go until expiration. That's December of 2027. It's a long ways out in the future. It has its own expectation, its own implied volatility. That's the average of the strike prices in this expiration. And that's plus or minus about $100. So if you think about it, this one, this option that expires in 2 days, has a plus or minus of about $10 out to a plus or minus of about $100 900 days from now. So that's enough range for the stock to move up or down quite a bit. So that can give you a way to select strike prices when choosing an option strategy, when choosing a duration. Now, the other thing to think about is, remember we talked about the fact that implied volatility rises into an earnings announcement or stays elevated into an earnings announcement and then drops afterwards. Well, look at the difference here between the option that expires in 2 days and the option that expires in 9 days. There's a pretty good drop in implied volatility. Even if I didn't look at the chart and I did not know that there was an earnings announcement coming up tomorrow in the next week, I could probably get pretty close within the same expiration cycle by looking for where there is elevated implied volatility. That's going to tell me where that earnings announcement is. Okay. All right. So now that we've got that sense in mind here, where does this number come from? Where does that implied volatility number come from? Well, here's what we're going to do. I'm going to open this up and we're going to go to number 4, and that's our implied volatility per strike. So our 4th way to look at implied volatility here on the Thinkorswim platform is to open up our option chain. And I've got 150 strikes here. And what I've got now is an implied volatility for each one of those strikes. I'm going to customize my column, and I'm simply going to put in here IMP, implied volatility. And I'm going to remove those other 2. We're going to click on OK. And now I've got a column that shows implied volatility for each one of those individual strikes. That's an implied volatility percentage for each one of those individual strikes. So in aggregate, all of these averaged out for a particular strike, for a particular expiration date. And looking at this time frame, that's going to get me this average right here. Okay, that's going to get me this average right here for that particular expiration. So I can show that implied volatility here on the option chain for each one of my strike prices. So I can see the level of inflation for each one over the level of price inflation for each one of those particular strike prices. And again, disparity. Now, here's something to think about, right? Implied volatility is going to be a function of supply and demand. So this average of implied volatility is oftentimes going to be centered right around the at the money strike or very close to the at the money strike. There might be a little bit of a lean one way or the other directionally, but it's not enough to necessarily give us a clue about which way the market is leaning. So we can see implied volatility for each strike price. So that is our next number 4 level of viewing implied volatility. Now, George mentioned Vega before. Vega is the sensitivity of our option premium to changes in implied volatility. So this is taking volatility one more step. So here's what we can do right here on the option chain. In my layout, and as I customize that layout, I could add Vega. Vega is the option Greek that tells us the sensitivity of the option premium to a change in implied volatility. And I'm going to click on OK. And now I've got a Vega column. So I'm seeing Vega relative to implied volatility. So if my lowest implied volatility is going to be right around that at the money strike, my highest implied volatility is going to be further out. Well, it's exactly the opposite for Vega. Typically, the highest amount of Vega or the greatest amount of implied volatility sensitivity is going to be centered right about the at the money strike. And that's going to tail off as we get deeper in the money. It's also going to tail off as we get further out of the money. In fact, we may get far enough out of the money that we don't see any sensitivity to implied volatility at all. Now, Vega is one of those tools, one of those option Greeks. In fact, it's probably the only, until you get into some of the second order derivatives, it's really the only of the option Greeks that we primarily talk about, delta, gamma, theta, and Vega, that becomes less significant as we get closer to expiration. And I'll show you the difference. I'm going to close down the number of strikes. I'm going to make 4 strikes here. And what I'm going to do is I'm going to open up several different expirations. So this is 9 days to go until expiration. That Vega number is 13 cents. 2 days to go, that Vega number is 6 cents. I go out to 51 days to go, that Vega sensitivity is 31 cents. And if I go really far out here, let's go to 261 days, you can see that it's just about double that. That's about 70 cents of implied volatility sensitivity for a 1% move in implied volatility. So this means this Vega number, let's just choose this Vega number 51 days out to go until expiration at this strike price. If implied volatility were to go up 1%, our option premium should gain about 31 cents. If implied volatility were to go down 1%, our option premium should lose about 31 cents. So Vega becomes less significant as we get closer to expiration, more significant the further away we are from expiration. So that also gives some insight into how some traders may go about choosing duration for an option trade. If you have a strategy that is not particularly sensitive to implied volatility, well, that might be an option that you can choose to trade further out. If you have a strategy that is sensitive to implied volatility, you want to diminish or mitigate that sensitivity, some traders may then choose an expiration date that is closer dated to minimize the impact of those changes in implied volatility. So that's the other way that we can look at this, is by looking at Vega on our individual strikes right here on the option chain. Now, while we're still here on the option chain, there are a couple of other tools that we can use to see implied volatility. So number 6, here's what we've gone so far. VIX, implied volatility on the chart, implied volatility on the option chain, implied volatility per strike, Vega per strike. Now we're going to look at today's option statistics. So I'm going to come down to the bottom of my option chain. And you might have to click on that drop down to open this up, but that is today's option statistics. And there are some things that we have here on today's option statistics that are very helpful in recognizing where implied volatility is. Number one, we've got this view of implied volatility. And again, that's going to be the average implied volatility based on what we're seeing on that blue line chart on the chart of the stock itself. When we put implied volatility on there, that's what we're getting here, is that implied volatility number. We're also seeing historical volatility. But here's the important number. And that's this one, current implied volatility percentile. So if I just told you that implied volatility currently was 39%, you don't know if that's high or low because I haven't given you any context. If I told you right now that outside in West Jordan, Utah, it's 52 degrees on the 30th of May, you don't know if that's hot or cold. But if I told you that usually it's up in the high 60s in May in West Jordan, then you would say that's probably a little bit colder than typical. So if I say that implied volatility is at 39%, and I put it into the context that the highest implied volatility has been is 71%, and the lowest implied volatility has been is 18%, that tells me that implied volatility right now is at about the 40th percentile. So let's just kind of draw this out. If this is our high, that's 71%, and our low is 18%, where does 39% fall within this range? Well, it's going to fall kind of right about here, and that's at the 40th percentile. So we put it into a relative range. And that's an important thing to think about, right? Taking a look at that current implied volatility percentile. Remember what we said about implied volatility, though? Implied volatility is mean reverting. So if implied volatility is high, it tends to fall, right? If implied volatility is low, it tends to rise. So if I've got an implied volatility percentile number that's about the 40th percentile, it's probably kind of right in this range here. It's probably not going to move all that much. It might fall, it might go higher, but I don't know for sure. But if I had an implied volatility percentile that was down in the 10th percentile, it's likely that that implied volatility is going to go up before it goes further down. And if I have an implied volatility percentile that's up in the 100th percentile, it's likely that that implied volatility is going to fall before it goes up. So this can give us, again, that current implied volatility percentile can give us a measure of what's likely to happen to implied volatility. And it also is a determining factor for some traders in making a decision about what strategy they might choose. Higher implied volatility percentile, they might look for a selling strategy. Lower implied volatility percentile, they might look for a buying strategy or a strategy that depends on a long option premium. Now, one other tool that's right here on this chart that I wanted, or on this information down here in today's option statistics that I wanted to talk about, is this one right here, and that is the volatility sizzle. Sizzle on the Thinkorswim platform always refers to the current information relative to the last 5 days. So whenever you see sizzle, that's what you're thinking about, is what that current number is relative to the last 5 days. So this volatility sizzle number right here is the ratio of where implied volatility is right now to the average of the last 5 days. So what that tells me, with a volatility sizzle number of 0.96, volatility is a little bit less than its typical over the last 5 days. So volatility's probably come down a little bit in the last few days, and maybe especially today. So that number right there can give you an idea of which direction volatility is moving. Is it higher or lower than it has been for the last day? That's the last 5 days. That's volatility sizzle. You can do the same thing with stock sizzle, with sizzle index, with call sizzle, with put sizzle. Sizzle index is simply the average of the call and the put sizzle. Where are those call and put prices going? Are they moving higher? Are they moving lower? And this tells us that those prices are moving lower. But this is another way to look at volatility on the Thinkorswim platform. and another tool that you can use to help make decisions about what strategy that you might choose or what particular instrument you might choose to trade. So that's today's option statistics. Now, I'm going to come down to the bottom here because we've got more to talk about, more ways to look at implied volatility. So what I'm going to do is I'm going to come all the way down here to product depth. And some of you may not have looked at this particular tool before. But here's what we're going to do is we're going to look at our options, and we're going to change our gamma function here. We're going to make this implied volatility. So we're going to look at implied volatility. Now, right now, what we're looking at is the implied volatility, the average implied volatility for calls and puts across all of the expirations. Because remember, we've got that average. So here's what I'm going to do. I'm going to simplify and clean this up a little bit. I'm going to come right here. I'm going to click off of all series, and I'm just going to go out to an option expiration the 30th of May here. So about 28 or so days to go until expiration. And we'll just look at the implied volatility for calls and puts across all of those strike prices. Now, not all of them, because we've got more strike prices beyond 245 and 180. But you can see on the call side and on the put side, there might sometimes be a little bit of disparity between implied volatility for the calls versus the puts. This is where you would also see implied volatility skew if puts are priced more heavily than calls. That can give you an idea that maybe put buyers are buying those options. Or if calls are priced more heavily, that call buyers are leaning into perhaps speculating. And you can also see the average, if we look at implied volatility, this is the average across calls and puts, and you can see where that implied volatility goes for those strike prices. And you can start to see this. This is where you start to see like those volatility smiles, volatility smirks. Great way to statistically get into this, but this is a deep tool, and it is one that can be very effective in helping you to see some of the characteristics of implied volatility. That's down here in product depth. That's number 7. Number 8 is on the Analyze tab. So we're going to go to the Analyze tab. Here we are on Apple. I have a number of positions here on Apple. I'm going to take my stock position off. We're going to look at some of these positions, and we're going to kind of squish all of this together. We're going to make sure that we've got a couple of positions in here. There we go. I've got a long stock position. I've got a couple of other options in here that are not traded. We'll kill that one. But here's our implied volatility. One of the things that we can do is we can look at implied volatility. I'm going to put on a simulated trade really quickly. I'm just going to buy a long call spread here, okay? And just do that in our simulated trading. I'm going to take our stock prices off. Here's our long call spread. One of the ways that we can see implied volatility is right here in our price slices. We can see that Vega sensitivity. The other place that we can see implied volatility here in the Analyze tab is if we open up more of our parameters here, right? Now we can adjust up or down implied volatility and see the impact that that has on our trade. So this gives us another way to gain a bit of a forward or backward look and a bit of a what if scenario playing here in terms of implied volatility. We can adjust that and see what the impact is on our position that we might be analyzing here on the Analyze tab. All right. Now, the other thing that we can do, and most traders don't know this, even if they use the Analyze tab quite a bit, is you can change the information being shown up here on the Analyze tab from P&L Open. We can change that to Vega, and you can see that Vega sensitivity based on the stock price, based on the time, and you can see that impact to option premium based on that sensitivity to implied volatility. So that's another way that you can visualize implied volatility on the Thinkorswim platform. That's number 8. Number 9 is right here on the Scan tab. Let's go to the Scan tab. And one of the things that you can do is you can change one of these filters. Let's put one of these filters on here. Let's put on here an option filter, and we can put right here implied volatility on as a filter in running a search. So we can run a scan based on that implied volatility number And you can choose to filter in high implied volatility, low implied volatility. One of the other things that you could do, you can do this in the live money account, but not in the paper trading account, is you could choose to put on here a study. And one of the studies that we could use in this particular case is implied volatility percentile. And you could bracket a certain range. So if you wanted to see implied volatility percentile numbers, that current implied volatility percentile that we looked at on today's option statistics, you can put that into a search right here using that study, implied volatility percentile. Now, that brings us to number 10. The number 10 way to look at volatility here on the Thinkorswim platform, and that is on the Market Watch tab. So let's go to the Market Watch tab. Let's open up a watch list here. And in fact, I'm going to open up a watch list. I'm just going to pick one of my personal watch lists here that I run fairly often, and based on some of the scans that I've already built. The one that I'm going to run here, actually, we could run a number of these. You could do it on a public watch list as well, doesn't matter. But the one that I'm going to choose here is one that we built last week, and that is our Sarasota scan. I was at a branch event last week. We came up with a bunch of stocks that met a particular characteristic. And here's what we're going to do. I have it already here in this list. Here's our implied volatility number right there. Express that as a percentage. But you can add that to any watch list by clicking on that gear icon, clicking on Customize, and coming over here and typing in IMP, not IMO, IMP, implied volatility. And we're going to put implied volatility on our chart so that we can see it as a number. And there is that implied volatility number there in a column header. And you can sort this list by that implied volatility number so you can see where that implied volatility number is. Now, you could also create, and I know that we've done this before, this is getting a little bit deeper into it, but right here in this column header, you could create a custom study and a custom header. And I think Mike Fairborn has done that, maybe James Boyd as well, that shows current implied volatility or IV rank here on that list, and you can sort based on that list. So 10 different ways to look at implied volatility on the Thinkorswim platform. VIX on the chart, implied volatility of an individual stock on the chart, implied volatility on the option chain as a whole, implied volatility per strike, Vega per strike on today's option statistics in the product depth tool, the Analyze tab, the Scan tab, and on the Market Watch tab. And I'm sure there are other ways to look at implied volatility, but those are the top 10 ways to look at implied volatility here on the Thinkorswim platform. I hope this has been helpful for you in helping you to understand. If you want to learn a little bit more about implied volatility and all of its variations, one of the things that you can do is you can come right over here to the Trader Talks webcast channel, and you can use this search box, and you can type in the words IMPLIED volatility. And now, oh, look at that. There's James Boyd. Why implied volatility matters. James Boyd, using implied volatility. How do you do it? Technical analysis with volatility. James Boyd, I will tell you this, talks about volatility all the time, probably in his sleep as well. So that being said, guys, thanks for joining me. Thanks to James Boyd for helping out. Remember to click on that feedback survey and let us know what you think about this particular webcast. My thanks to our great production staff for helping out as well. And we will see you guys again very soon. Have a great day, and we'll catch you in the rest of the webcast. Take care, everybody. Bye-bye.